Now, if you've been following along since episode one, I've been pretty focused on dividend strategies. SCHD has been my core holding. We talked about Boglehead principles, the core and satellite approach, and I even covered some of those high yield traps that nearly got me in trouble. But recently, I've been wrestling with this question that keeps coming up in the comments. Like, if you're trying to retire early, should you actually be chasing dividends at all during the wealth building phase? And that question led me down this rabbit hole of research that honestly changed how I think about early retirement portfolios. Because here's what I discovered, and this was one of those humbling moments where the data just smacks you in the face. Focusing too heavily on dividends when you're building wealth might actually be working against you. Let me share some numbers that really opened my eyes. Over the past 5 years, VOO, that's Vanguard's S&P 500 ETF, has delivered about 15.9% annualized returns. Compare that to SCHD, which I've been singing the praises of, and we're looking at around 11 to 12%. Now, SCHD gives you that nice 3.7% dividend yield compared to VOO's 1.3%. But think about this. Would you rather have a portfolio worth $2 million yielding 1.5%, or a portfolio worth $1 million yielding 4%? The $2 million portfolio gives you $30,000 a year in dividends. The $1 million portfolio gives you $40,000. But here's the kicker. You've got twice the principal with the first scenario, which means way more flexibility, way more security, and honestly, way more options for how you want to structure your retirement income. This is where I started thinking about what I'm calling the three pillars of an early retirement portfolio: Bitcoin, VOO, and SCHD. And I know what you're thinking, Bitcoin, really, Jordy? But hear me out, because when I looked at the numbers, even with all its volatility, Bitcoin has delivered somewhere between 49 and 230% annualized returns over the past decade, depending on when you got in. Now, I'm not suggesting you go crazy with Bitcoin. We're talking about maybe 5 to 10% of your portfolio max. But for someone trying to build serious wealth in 20 to 30 years instead of 40, that potential upside might be worth the sleepless nights. The key is understanding that Bitcoin is the growth engine, VOO is your steady wealth builder, and SCHD is your stability and income component. And let me break down how I'm thinking about allocation now. And this is based on where you are in your journey. If you're in your 30s and targeting retirement around 40, I'm looking at something like 70% VOO, 20% SCHD, and 10% Bitcoin. Super aggressive, sure, but you've got time to weather the storms, and you need that growth to build enough wealth for a 40-year retirement. As you get closer to your target retirement date, let's say you're in your mid 40s, you might shift to something like 55% VOO, 35% SCHD, and keep that 10% Bitcoin position. You're adding more stability and income, but you're still prioritizing growth because you're going to need that portfolio to last decades. Now, here's where a lot of people mess this up. And I made this mistake myself in my early investing days. They think because they want dividend income in retirement, they should be accumulating dividend stocks throughout their working years. But that's backwards thinking, and the tax implications make it even worse. If you're working and earning good money, you're probably in a higher tax bracket. Those dividend payments are getting taxed every single year. Even qualified dividends and most of SCHD's dividends qualify for preferential tax treatment, or say you're still looking at 15 or 20% tax rates if you're making decent money. That's money getting pulled out of your compounding machine every year. But here's what really opened my eyes. If you're in the 24% tax bracket and you own a REIT or some other high yield investment that pays ordinary dividend rates, a 6% yield becomes 4.56% after taxes. Meanwhile, someone holding VOO in a taxable account is paying basically nothing in taxes until they sell, letting that money compound without the government taking their cut every year. This brings me to something that took me way too long to figure out. account location strategy. And this is crucial if you're serious about early retirement because you've got this gap between when you retire and when you can access your retirement accounts without penalties. Your 401k and traditional IRA should hold your high yield stuff, right? Bonds, REITs, dividend focused funds that generate a lot of taxable income. Your Roth IRA is perfect for high growth investments that you won't touch for decades. And your taxable brokerage account, this is your early retirement bridge, should focus on tax efficient funds like VOO that don't create a big annual tax bill. The strategy that makes the most sense for early retirement is building up that taxable account with growth focused investments, then using Roth conversion ladders to systematically move money from your traditional retirement accounts to Roth accounts during your early retirement years when your income is lower. Each conversion has a 5-year waiting period, but if you plan it right, you can create this systematic access to your retirement funds without penalties. Now, let me address the elephant in the room, the safe withdrawal rate for early retirement. The traditional 4% rule assumes a 30-year retirement. If you're retiring at 40 and planning to live to 90, that's 50 years your portfolio needs to last. Most research suggests early retirees should plan on 3 to 3.5% withdrawal rates to be safe. That means instead of needing 25 times your annual expenses, you need closer to 30 times. If you want to spend 60,000 a year in retirement, you're looking at needing about $1.8 million, not 1.5 million. That's why the growth phase is so critical. Like you need to build a bigger pile of money, which means total return matters more than dividend yield during the accumulation years. But here's something interesting I discovered about dividend growth versus high yield. SCHD has grown its dividend at about 9.3% annually over the past decade. That's phenomenal growth. And it's one of the reasons I still think SCHD deserves a place in an early retirement portfolio. But during the wealth building phase, that dividend growth is less important than total return. Think about it this way, and if you've got 20 years until retirement, SCHD's dividend might grow from 3.7% to 8 or 9% yield on your original cost basis. But if VOO grows your principal faster, you end up with more money generating whatever dividend yield you can get when you actually need the income. This is why I think the three-pillar approach makes sense. VOO gives you broad market growth and the best long-term total returns. SCHD gives you dividend growth and some stability, plus exposure to those quality value companies that tend to hold up better in tough markets. And Bitcoin gives you that potential for life-changing gains, even with a small allocation. And the key is understanding that this isn't a set it and forget it allocation. As markets move and as you get closer to retirement, you need to rebalance. When Bitcoin goes on one of its runs and suddenly represents 20% of your portfolio instead of 10, you trim it back and buy more VOO or SCHD. When the market crashes and your allocation gets out of whack, you're buying more of whatever got hit hardest. Now, I want to talk about something that really surprised me in my research. The sequence of returns risk for early retirees. This is the risk that you hit a major bear market right when you retire or early in retirement, which can really mess up your long-term withdrawal strategy. You might think that dividend-focused portfolios protect against this risk because you're getting income regardless of stock prices, but the data doesn't really support that. During major market downturns, companies cut dividends just like stock prices fall, and dividend-focused portfolios often underperform total return portfolios during recovery periods, which means you might be worse off 5 or 10 years later. The better protection against sequence risk is having that larger portfolio to begin with, plus keeping some cash on hand during the early years of retirement. If the market crashes in year 2 of your retirement, you can live off cash and avoid selling stocks at the bottom. This brings me to one more crucial point about high yield strategies that I learned the hard way. When you don't actually need the income yet, when you're still working and building wealth, High yield investments can actually hurt you in multiple ways. First, there's the tax drag we talked about. Second, there's the opportunity cost of lower total returns. But third, and this one really stung when I calculated it for my own situation, there's the forced lifestyle inflation. When you're getting significant dividend income that you don't need, it's really easy to just spend it instead of reinvesting it. That spending becomes a habit, and suddenly you need more income in retirement than you originally planned. I've seen this with my own portfolio. When I was getting 8 or 9 thousand a month in dividends during my high yield phase, I definitely wasn't as disciplined about my spending as I should have been. That money felt free, even though it really represented opportunity costs from not having it invested in faster growing assets. And the lesson here is that dividend income should match your actual income needs. During the wealth building phase, you don't need income, like you need growth. During retirement, you do need income, and that's when dividend strategies really shine. So, how does this all come together in practice? Let me walk through what I think makes sense for someone serious about early retirement. Step one, back here, max out all your tax advantaged accounts first. Your 401k, especially if you get matching, then your Roth IRA, then HSA if you have access to one. Use these accounts for your SCHD position and any other dividend focused investments. Step two, build your taxable account with VOO as the core holding. Like this is your early retirement bridge account. So you want tax efficient growth that you can access without penalties. Add your Bitcoin position here too, since most retirement accounts don't offer crypto options. Step three, plan your withdrawal sequence. Taxable account first, then Roth contributions, then your conversion ladder funds, then traditional retirement accounts after 59 and a half. This minimizes taxes and penalties while giving you access to your money throughout your retirement. The bottom line is this, like the successful early retirement isn't about generating enough dividend income to cover your expenses. It's about building enough total wealth that sustainable withdrawal rates naturally cover your expenses. And the path to building that wealth runs through total return investing, not dividend chasing. I know this might sound different from some of my earlier episodes where I was really focused on dividend income, but this is what I love about this journey. You keep learning, the data keeps teaching you things, and you adjust your strategy based on what actually works. The three pillars: Bitcoin for potential upside, VOO for steady wealth building, SCHD for stability and growing income, give you the best of all worlds: growth when you need it, income when you need it, and the flexibility to adjust as your situation changes. That's what I've got for you today. Next week, we're going to dive deeper into that Roth conversion ladder strategy I mentioned, because if you're serious about early retirement, you need to understand how to access your retirement funds without getting killed on penalties. Thanks for joining me. And remember, the goal isn't to retire on dividends. The goal is to build enough wealth that you can afford to retire on whatever strategy makes the most sense when you get there. See you next week. This is Jordy, and you've been listening to Retire on Dividends. If this episode helped you think differently about your early retirement strategy, hit that subscribe button and share it with someone else who might be chasing the wrong metrics. Until next time, keep building that wealth.